Hey everybody, this is a quick illustration of how to account for bonds from the investor perspective. I also have the issuer's accounting entries on the left-hand side for comparison, but we're going to focus on the investor. Let's assume that we purchase bonds from Needy Corporation, and the bond contract says, I owe you $600,000 in 3 years plus 5% every December. So here's a timeline representing these cash flows according to the contract. And remember that the contract is set in concrete. So the cash flows don't change. What does change is how much we have to pay for this investment at the beginning. Let's assume in the first example that the market rate of interest is equal to the 5% stated in the contract. So when we present value these cash flows using the market rate of interest of 5%, the price of this bond will be equal to the face value because the market rate equals the stated rate. So we're going to record this investment at $600,000, and the cost of that investment would go to the asset account, debt investments. And at the end of each year, we would record $30,000 of interest, and that would be go into interest income at the end of the first year, end of the second year, and so on. The rest of the accounting for this investment would depend on how we have it classified. If we expect to hold this investment until it matures, it would be classified as a held to maturity investment, and we would simply report the amortized cost on the balance sheet. But let's assume it's classified as a trading security or available for sale. In that case, we would need to adjust the carrying value to reflect the market value of the investment. Let's assume at the end of the first year, the market value is $600,000, so there is no adjustment needed. At the end of the second year, the market value is $595. So we need to bring the $600,000 carrying value down to $595, so we would put a credit into the adjustment account and debit an unrealized loss. If the investment is classified as a trading security, the unrealized loss is a temporary account under retained earnings and would go onto the income statement. If it's classified as available for sale, the unrealized loss is considered other comprehensive income and would not go on the income statement, but instead would go onto a statement of comprehensive income. Now let's look at a situation where the market rate of interest is higher than the stated rate. So when the market rate goes up, bond prices fall, and so the price of this bond would include a discount. The present value using that market rate of 6% would be a lower price than the face value, so it would have a discount. So we would record the debt investment at cost, and that discounted price would go into the asset account. At the end of each year, we would record the collection of the interest and also the amortization of that discount. So I've got the account here represents multiple years. So let's look down here at the first journal entry. At the end of the first year, we would debit cash for $30,000. That's from the contract. We would credit the interest income based on the carrying value at the beginning of that first year times the market rate of interest, and the difference between the two is the amount of the discount that we would amortize. Notice that when we amortize a discount, what we're doing is we're gradually increasing the carrying value of that investment, and over time it'll finally get up to the $600,000 is the maturity value. So at the end of the first year, the amortized cost is $589. The market value at the end of the first year is $600,000. So we need to add $11,000. Notice in the blue, $11,000 to bring that carrying value up to $600,000. When we debit the fair value adjustment account, we're going to credit an unrealized gain to reflect that increase. If it's a trading security, the unrealized gain is a temporary account unretained earnings, meaning that goes into net income. If it's an available for sale, then that unrealized gain is not on the income statement, but it's considered other comprehensive income, and it would go onto the statement of comprehensive income. At the end of the second year, let's assume that we've amortized another year of the discount, and the fair market value is now $595. Well, the amortized cost is $594,340. We need to raise it to $595 to get the fair value adjustment account to the $660 that's needed. We would need to credit the fair value adjustment for $10,340, and we would debit an unrealized loss. Again, the unrealized loss is on the income statement if it's a trading security, and it's on the statement of comprehensive income if it's available for sale. Finally, let's go to the example of where it's a premium. The market rate of interest is down below the stated rate. When the rates come down, bond prices go up. When we present value these, again, we're taking these cash flows in the contract, we're bringing them back to the present value using that lower market rate of interest. And in this case, if it was 4%, then the amount we're paying for the bonds is $616,653. So we would debit the investment account for that cost. That goes into the asset account. At the end of each year, we're going to record the collection of that $30,000 of interest in the first year. Debit cash for $30,000. That's because that's what the contract says they will pay us. We're going to credit interest income for the carrying value times the effective rate, in this case 4%. And so that gives us interest income of $24,666, and the difference between the two would be the amortization of the premium that's included in that debt investment. So as we amortize the premium, we're gradually bringing the carrying value. Since it started with a premium, it's gradually coming down and approaching that $600,000 face value. At the end of the first year, the amortized cost is $611. If the investment is classified as held to maturity, we're through. If it's classified as trading security or available for sale, we need to bring it down to match the market value at the end of the first year. that's $600,000. So we would credit the fair value adjustment and debit the unrealized loss account. That goes onto the income statement. If it's trading security, it goes into other comprehensive income if it's available for sale. At the end of the second year, after amortizing some more of that premium, we have a carrying value of $605,772. The market value at the end of the second year is $595. So we need to bring this carrying value of $605,772 down to $595. So we need a credit balance in the fair value account of $10,772. When we compare that to what was in there before, we need to bring the fair value adjustment balance down, and so that would be a debit of $547 and a credit to an unrealized gain in this case. And that unrealized gain would be reported on the income statement if it's trading securities, but as other comprehensive income if it's available for sale. So again, on the balance sheet, the investment is reported at fair market value if it's a trading security or available for sale, but it would be simply reported on the balance sheet at amortized cost if it's a held to maturity investment. That's a lot to take in, but I hope that helps clarify the big picture.